Hello, everyone. Welcome to Money Rules, a platform where we can unpack the latest financial enforcement actions that are shaking up the banking world. And I'm your host, Vivek Sharma. And today, on 25th of Jan, we are diving into four major cases that show how regulators are tightening their grip on financial institutions worldwide. So let's start. The first news story which is making headlines is the Indian banking saga. Let's start with yesterday's breaking news from India. The Reserve Bank of India has just dropped the hammer on three major banks, with Jammu and Kashmir Bank taking the biggest hit, a whopping 3.31 crores of fine. And what did they do wrong? So there were three major failures. First, poor handling of basic savings account, a very sloppy customer verification, KYC, and breaking loan regulation rules. But Jammu and Kashmir Bank wasn't the only one. Bank of India got slapped with a 1 crore fine, and Canara Bank is facing a 1.63 crore penalty. These fines actually show that RBI has a very serious stance on regulatory compliance in and starting the year with a bang. The next news is pretty interesting, wherein we move to Luxembourg. So moving to Europe, where Luxembourg's financial watchdog, the CSSF, has issued a serious reprimand to JP Morgan's Luxembourg branch. This case is particularly interesting because it involves Ukraine-related sanctions compliance. So the bank stumbled in three critical areas. The first one was slow implementation of sanctions screening. The second was delayed freezing of funds. And the third was poor monitoring of fund operations. Well, what makes this case notable is that JP Morgan actually self reported some of these issues, showing how banks can also become more proactive in addressing their compliance failures. So, a thumbs up to JP Morgan for doing that and setting a new standard. The other news item that I want to focus upon is, well, now you might be wondering why these cases matter. Well, 2025 is showing us some clear trends in financial compliance. First, the regulators worldwide are intensifying the supervision. They are not just checking boxes anymore. They are demanding real effective compliance programs. Second, the focus is shifting from just having rules to implementing them quickly. As you saw in both cases, timing is crucial. Slow compliance is becoming as problematic as no compliance. Third, banks are facing increasing pressure to upgrade their compliance technology and systems, especially for sanction screening and customer verification. So, some of my recommendations, as per my understanding, working in the financial crime sector for the last 15 years, is that for financial institutions watching these developments, here are three key takeaways. So, the first one is review your screening systems, make sure they work in real time. The second, strengthen your customer verification process. And the third is invest in better compliance technology and training. And I feel the training is the missing part of the puzzle in this case. So that's a wrap for today. While we did a deep dive into the world of financial enforcement, we need to remember that prevention is always cheaper than penalties. And join us next week for more insights into the evolving world of financial compliance. Signing off, Vivek.